All right, let's talk about Plug Power, ticker PLUG. As we head into the weekend, the market is of course closed. The last session on Thursday, November 7th, 2025, saw Plug Power close at $2.65. But that's not the whole story. It was a very aggressive day, with the stock shooting up 5.58% or 14 cents. And even after the bell rang, in after-hours trading, it tacked on another penny, sitting at $2.66. Now, the expectation when you see a 5.5% pop on a stock this beaten down is that it's just a meaningless, random bit of noise, a dead cat bounce, a brief gasp of air in an otherwise relentless drowning. The common belief is that this is just retail traders on platforms like the Robinhood app or SoFi Invest gambling on a low-priced name. But the reality might be something significantly more complex. That 5.5% move, when you look at the chart, wasn't just a gentle drift up. It was a spike. That kind of price action in a heavily shorted stock often isn't optimism, it's desperation. It could be the first sign of shorts getting nervous and starting to cover, perhaps ahead of an anticipated news event or a technical level being breached. The expectation is that Plug Power is a failing company. The reality is that it's a volatile company, and that volatility is a weapon that cuts both ways, creating moments of intense pressure for both bulls and bears. The common ground for almost everyone looking at this stock, from a seasoned pro managing Fidelity wealth management accounts to someone just starting out with online investing, is that Plug Power has been an absolute disaster for long-term holders. This isn't a dip, it's a crater. A stock that once flirted with prices over $70 is now struggling to stay above $2. The narrative is simple. This was a pandemic-era hype stock, a poster child for the green energy bubble that has now collided with the harsh reality of high interest rates and the brutal economics of its own business model. The company burns through cash at an alarming rate. That's not an opinion, it's a fact directly from their financial statements. Every quarter, the expectation is for massive losses, and the reality is that Plug Power usually delivers on that expectation. This has led to a desperate need for capital, resulting in painful dilution for existing shareholders. Every time they sell more stock to keep the lights on, the value of each individual brokerage account holding those shares gets watered down. It's a classic growth trap, and the market has turned viciously against it. People look at the stability of an Apple stock or the clear AI-driven growth of an Nvidia stock, and then they look at Plug and they see a science project that's run out of funding. But let's challenge that. Let's look at the other side. The expectation is bankruptcy. The going concern warning from their own auditors earlier this year cemented that fear. But what if the reality is that Plug Power is just moments away from finally turning the corner, and this price is the point of maximum fear? The 5.58% jump on Thursday, why? There was no massive company-specific news, but the broader market has been sniffing out a potential pivot from the Federal Reserve. A high interest rate environment is poison for a company like Plug Power, which needs to borrow heavily to build its massive capital-intensive hydrogen plants in Georgia and New York. If rates are perceived to be peaking or even coming down, the entire financial model for Plug changes overnight. Suddenly, the math on their projects looks different. That's the macro pressure. Then there's the sector momentum. The entire green energy space has been obliterated. But these things move in cycles. The assumption is that hydrogen was a false start. The reality is that the industrial need for hydrogen, particularly green hydrogen, hasn't gone away for sectors like steelmaking, fertilizer production, and heavy transport. What Plug Power is trying to do is build the entire ecosystem, end to end. This is the core of the bull and bear fight. The expectation is, oh, they sell fuel cells for forklifts. That's how they started, and it's a good business, with clients like Amazon and Walmart. But the reality of their current business model is far grander and far, far riskier. They are trying to be the producers of the green hydrogen itself with their electrolyzer technology. They are trying to be the logistics and distribution company that liquefies and transports that hydrogen. And they are trying to be the end-use provider with their fuel cell systems. It's an incredibly ambitious plan. The problem is, it's like trying to build Tesla stock by not just building the cars, but also building the national charging network, the power plants to supply them, and the lithium mines, all at the same time, with no initial profit. The cash burn is immense. The risk of execution failure is sky-high. This is why many automated investing sites or a robo-advisor like Schwab Intelligent Portfolios would likely never touch this. It's a human, high-conviction bet or nothing. Let's talk about the recent trading. This stock doesn't trade, it lurches. You'll see massive volume spikes on days with no news. This is the domain of algorithms, short sellers, and day traders using platforms like interactive brokers that offer the fast execution for this kind of volatility. For the average person using a Fidelity mobile app to check their Fidelity IRAs, this is terrifying. The stock is heavily influenced by government policy. The 45V tax credit from the Inflation Reduction Act was supposed to be the massive catalyst. The expectation was that this would make green hydrogen instantly profitable. The reality has been a bureaucratic nightmare. The guidance from the Treasury on how to qualify for those credits has been a point of intense debate. If the rules are too strict, for example requiring new renewable energy sources for every hour of operation, it could make Plug's entire economic model unworkable. If the rules are relaxed, it's rocket fuel. That 5.5% jump could have been related to whispers from Washington. With this stock, you always have to watch the politicians as much as the profit and loss statement. This brings us to the future outlook. What happens from here? There are really only two paths, and very little middle ground. The first path is the bear case, the expectation that is currently priced in. The company continues to miss production targets at its new plants. The cash burn accelerates. They fail to secure the large Department of Energy loan guarantee they've been chasing. The capital markets, tired of promises, shut them out. They are forced into more and more toxic financing, diluting the stock into oblivion, or worse, they face insolvency. This is the reality that has the stock at $2.65. This is the outcome that short sellers are betting millions on. They see a company that has consistently overpromised and underdelivered, and they believe the final chapter is approaching. This isn't an investment, it's a speculation on collapse. Then there is the bull case, the contrarian reality. In this scenario, the next few months are transformative. The Georgia liquid green hydrogen plant finally ramps to full nameplate capacity. The New York plant follows. Suddenly, Plug isn't just using hydrogen, it's a major seller of it, at a time when industrial demand is solidifying. The Department of Energy loan comes through, providing a massive low-cost capital injection that removes the going concern risk overnight. The 45V guidance is finalized in their favor. With a clear path to profitability and a secured balance sheet, the market is forced to reevaluate everything. The shorts, trapped in a stock with a low float and high cult-like following, are forced to cover, triggering a massive squeeze. In this reality, the stock doesn't just go up, it explodes. It wouldn't be the first time. We all saw it happen a few years ago. People who do their self-investing and get this call right could see immense gains, which is why so many are still drawn to it, checking their SoFi stocks list every 5 minutes. So, where do we stand? The expectation is failure. The reality is that Plug Power is a binary bet on the future of an entire industry, held together by government subsidies and shareholder faith. The 5.58% move is a reminder that this stock is still alive and that trapped energy can release violently. It's a barometer of macro fears and policy hopes. It is not a stock for an intelligent portfolio. It's a stock for those who have done deep research, who understand the technology, who have read the fine print on the 45V credits, and who have an iron stomach. It's a true Robinhood stock trading favorite, for better or worse. I have to ask you, and be honest, comment below. What percentage of your portfolio are you really willing to put into a name this speculative? Are you holding Plug Power right now, or are you shorting it? To wrap this up, the tension here is palpable. The market's expectation is that Plug Power is a $2.65 stock, meaning it's pricing in a very high probability of failure. The company is walking a tightrope of cash flow, project execution, and political lobbying.